right, just another AWM Insights. We got a new setup.
Here we are.
We're busting in some wine. We can thank Eric for this. He
Good tip.
He goofed around with us and said, "Hey, I want you guys to act like you're having a glass of wine together and talk about the market." So what the heck? Let's have a glass of wine and talk about the market. So new little feature, more fun for us than probably anybody, but we're going to feature a new wine every one of these podcasts now. So AWM, you're sponsoring the wine.
There we go.
Appreciate that. But yeah, Justin, you and I are familiar with this wine. Devil at Wines, good friend, just awesome dude and even better winemaker somehow. But this is a Ramato. It's, kind of looks like a rosé. He probably wouldn't want us to call it that, but pretty cool process, unique wine. He does it in like clay vessels, brings
Old
some
school,
uniqueness
yeah.
to it. So cheers. Buddy.
Cheers, man.
Let's talk about the markets.
There we go.
All right. Well, we've had a lot of volatility. Not surprisingly, I think, last week we talked about markets declined, and then we turn around and Monday, Tuesday, the markets actually explode, right?
Yeah,
so
impressively.
I think it just reinforces what we talk about so often. We can't time this stuff. It's impossible. Even when we think we know what's coming, and there's volatility probably likely ahead, at least in our viewpoint. But who knows when it's all going to show up. So from what you've seen, did it surprise you Monday, Tuesday? Like what in the heck happened? Why reverse after such a bad week?
Well, there's an old adage, you pushing on a string and bouncing back, or overselling, right? Where some sort of amount of negative news or some sort of fundamentals, right? And Friday was the end of a month, end of a quarter, just interesting time of the trading session that generally can drive interesting market activity, both up or down. So, you could potentially argue there was a little bit of not fundamental trading because of those interesting endpoints to various periods that drives, like I said, interesting market dynamics. Was I surprised? No, because again, you mentioned you can't really predict. There are, if you look at what happens after an up day, it's about a 50-50 coin flip. What's going to happen the following day? So that goes exactly to your point. You can't predict, certainly the market day to day. We can't predict the market month over month, week over week, year over year even. We know, luckily though, over the long term, it generally goes up and it goes up quite handedly. And one thing that I saw in the news too that I think is a perfect tie into this idea of predicting the future or the difficulty of it is retail real estate. I mean, 2 years ago,
it's
in
back
the midst of
pre-pandemic
highs.
Yeah.
So 2 years ago, in the midst of the pandemic, everyone was just putting a nail in the coffin of retail real estate, right? Mom and pop stores are going to be dead. Yeah. No one's going to buy retail anymore. No one's going to be leasing retail anymore. Lo and behold, fast forward to today, it's back to where it was, and it's had its best period of growth for 15 years. So, there are these people out there, and we talk about this quite a bit, that do put their opinion out there and try and predict the future, and
totally.
That's okay, but hopefully you're not making big investment decisions based on that, because if you have an opinion, that's one thing. Actually doing something about it is a whole nother. You have to be incredibly confident and really look at the underlying data behind that.
Totally. I thought the other interesting thing around the real estate sector I heard is, on the flip side, it was home sales. Like housing in general is back to pre-pandemic in the sense that we had this big boon through the pandemic. Housing prices just soared, and now we're starting to see a pullback there. And it could be interest rates, who the heck knows? But I think back to the point that you were talking about, like, even if you had the crystal ball and you saw this coming, interesting conversation, kind of shifting gears with what's going on with OPEC Plus, which I'll be honest, I just learned that the plus got thrown on the end. So, but they're going to cut production, try to manipulate price a little bit. Maybe they're aligning with the Russians, who the heck knows? But, the question comes like, how do you profit from this? And I think that's an interesting thing, right? Like, there's so many sides to this coin that yeah, you might have this vision into like, oh, okay, well, OPEC's going to cut production, drive up price, so maybe I'll play this way. Well, who the heck knows? What if the Biden administration turnarounds and now opens up U.S. More freely? So I think trying to predict all these dynamics, and like we're in a pretty, I don't know, it seems like to me a very complicated economic and policy position right now. Like how even if you could get it right, how do you play it? I think that's a tough thing.
Well, I mean, the simple answer is how you play it is have a diversified approach, totally. Put your financial structure in place. I know that's not necessarily as interesting, but it is proven out over time and in the data that is the best way of doing it. But to get a little bit more maybe opinionated about it or factual, really, to your point, it is a really complicated time right now. We have inflation, still not fully under control. Interest rates are at highs that we haven't seen over the recent history, especially for young new investors. You've never seen interest rates this high at all. There's a war in Ukraine that's not de-escalating, seemingly continuing to escalate, unfortunately. There's an election right around the corner. I mean, there's a lot that goes into the overall equation right now. Though the one piece I would say that is usually the case. There's usually a lot that's going on, both positive and negative. Maybe the scales tip a little bit more to the negative right now. But the market is always forward looking. It doesn't like uncertainty. And I would say there's probably a little bit more uncertainty than average right now, which is, you could argue, a big reason why we're seeing the volatility in the market action. That's happening. Interest rates have obviously been top of mind, and that's been a big driver of market declines. Will that continue? We don't know. We've talked about that. That's not a viable variable to use for predictive analytics going forward. But hopefully as uncertainty starts to fall off over time, I'm not going to say it's going to get better next week or early next year. Hopefully that does happen. But as that starts to fall off, then markets will generally start to calm down a little bit. And again, like I said, they're forward looking. So markets are looking at 6, 12, 18 months. So even if the present moment, the uncertainty around the present moment is still potentially similar to what it is now, if there's some light at the end of that proverbial tunnel into the future, we'll start to see some calming, I suppose.
And I think that's super interesting. Like you're talking about what the markets are pricing in. I was listening to a podcast actually on the way into the office this morning, and they were talking about how the market. So I talked to clients, right, and in the media, and the media is saying is like, oh, a recession is coming. A recession is coming. We know a recession is coming. And then on the flip side, you look at what the market's pricing in. The market's actually not pricing in a severe, So it comes back to the question, like, who am I going to trust? Am I going to trust the media and the pundits that are trying to generate ad sales, or am I going to trust the market participants? And it's clear in a way, at least time and time again, the best estimators of prices, are the broad market participants. And so I thought that was really interesting to see also stats wise, like all the S&P 500, the valuation is back to the 20-year average. So it's not like we've gone in this deep correction mode, which is basically the market indicating we don't expect this deep recession, or else they would price in a pretty severe drop at this point. Now, anything can happen. New information comes light, and the market participants price that in. But I think that's the interesting thing for people, when I'm talking to them, to realize is like, hey, the market does a pretty good job at pricing this stuff in when it's expected to happen.
Oh yeah, totally. More often than not, it's right to your point. And we'll see not only in addition to all these events or the current set of circumstances that exist today, we're entering into a new earnings season. The expectation is that earnings are roughly going to be in line with where they were last quarter. And that, I think, is a large reason why the market's not pricing in a recession. They're expecting, they being market participants, is generally expecting earnings to be flat. That's a key driver of valuation. again, interest rates have been a big headwind to valuations over the recent history, but I think you're seeing some bouncing across the bottom or some stabilization here. Granted, it's going up one day, down one day fairly drastically, but it's somewhat leveled out to an extent. And that's largely because there's a wait and see type mentality. I would say wait and see both around what the Fed's going to do further, wait and see around what inflation's going to be, wait and see what the employment report's going to be. And then I think one of the bigger variables probably right there with the Fed is what earnings are going to come in at in this most recent session or earnings season. So, all that being said, when you do bring it back together, the market has declined quite substantially. And we always say, hey, let's go back and look at the statistics. Let's look at the data. What does the data tell us to do? And we know that pretty consistently after major declines like this, there's a really nice bounce back. Doesn't happen immediately, but over a trailing subsequent 1 year, 3 year, 5 year period, you can see quite substantial returns from these more challenging periods of time. And that's really where we go back to say, hey, time in the market, staying disciplined, having the right strategy to allow you to weather these really pays dividends long term.
And I think that's the other thing, right? You think about other periods of time, even in somewhat recent history of some big policy changes, interest rate changes, et cetera. You think of like the early 90s and what followed after that, and people that went through the 2000 dot-com crash, and there's a little blip in 2002, and then you had 2008. And those are all scary moments, right? In the midst of it. But if I could tell people like, hey, go back and invest your money in 1990 and look at your account today, you're probably in a pretty darn good position,
sign
right?
Me up.
Yeah, sign me up. So, and if we look back at periods of history, and to me, I keep going back, I try to reinforce with clients, that's all about financial structure. Because, right, if you had money invested in 2000 that you were hoping to retire upon in a year or two, you should, I'd be scared to death as well, right? Like that's mind altering. But if I had set up my protective reserve and I was, in 1990, if I was investing, I guess at 10 years old, but great. I don't need that money for the next 30, 40 years. Like there is no better place to park your money, right, than the US stock market, world stock market, and allow everything to grow. And yes, some moments of pain and heartache throughout that period of time, but it's all psychological at that standpoint.
Yeah, if you have the right structure, it should be psychological at that point, and then go back to the data and understand it. Get comfortable with the philosophy, because that gives you the staying power. The other piece I would say to that, which I agree fully, is making sure liquidity also matches up with your liquidity needs.
Yeah, absolutely.
Liquidity of your holdings, right? We talk a lot about private investments, which we love, venture capital a little bit more specifically there, but private market investments in general, they're wonderful vehicles to grow wealth, but you need to match those up with your liquidity needs as well. Don't just over allocate to that asset class overall, because it might not match up with your liquidity needs. We actually do see that, unfortunately, more often than not with newer clients of really substantial wealth at some points, or in many instances, and they have these really powerful priorities and goals and want to make an impact, and their liquidity doesn't allow for them, and they haven't planned ahead of time for that. And I think that's another important piece to keep in mind.
Totally. I think that's a great point. And I think that, as we know, or most people know, the best way to actually learn things is to go teach it. So we're going to keep with that theme and give people listening to this a couple zingers, right? The zinger number one is just that, trying to time this stuff, even with a crystal ball. Yeah. You got to get too many decisions right? So number one, your zinger is, hey, look at last week and look at this week, and what a difference, a week makes, what difference a weekend makes, and what really changed, not a whole heck of a lot. And so, trying to time those things. So that's your zinger number one. Zinger two is just time in the market wins, right? Take them through that example, 1990 to today. Mm-hmm. Yes, you went through some correction points, but man, did your wealth just absolutely explode. Yeah. And then the lesson ultimately in all of this is what really matters more than anything is having the right financial structure in place, because it allows you to be rewarded for all these different things. So, Anyways, we'll wrap up for today. Hopefully you like the new wine segment. We encourage anybody listening to go to devilatwines.com, throw Devo an order there. You won't regret it. The wine's phenomenal. If you guys want to have a glass of wine with us, don't be afraid. Reach out. We're always down for a glass of wine. And shoot us a text, 602-704-5574. We'd love to, hear your questions, your wine recommendations, if that's your fancy. So until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.